As of 2025, an estimated $2.1 trillion sits in forgotten and abandoned 401k accounts across the United States. According to a study by Capitalize and the Center for Retirement Research, that figure represents 31.9 million individual accounts, left behind when workers changed jobs and never moved their retirement savings. New York State's hiring rate reached 3.7% in December 2025, above pre-pandemic levels, according to the NYC Comptroller's Office. The Bureau of Labor Statistics reported 372,000 job openings in the state that same month. In a labor market moving at that pace, decisions about retirement accounts get deferred, and deferral has a price. A 401k is employer-sponsored. When you leave a job, contributions stop. The account does not transfer automatically. It remains inside the former employer's plan until the account holder takes action. The national median tenure for private sector workers is 3.7 years. Vanguard's October 2025 update puts the average job change frequency at roughly once every 4 years. Bureau of Labor Statistics research on workers born between 1957 and 1964 found they held an average of 12.9 jobs between ages 18 and 58. Each job change is a retirement account decision that may never get made. According to Capitalize, 4 million accounts were left behind in 2024 and another 2.5 million in just the first 7 months of 2025. The rollover process is not standardized. Every plan administrator handles it differently. That complexity, compounded across millions of job transitions every year, is how $2.1 trillion ends up stranded. When leaving an employer, account holders have 4 options: leave the funds in the former employer's plan, roll the balance into a new employer's plan, roll it into an IRA, or take a cash distribution. Each option carries distinct tax implications, fee structures, and long-term consequences. None of them are automatic. All of them require a decision. Leaving the money in the old plan is permitted when the balance is $7,000 or more, a threshold raised from $5,000 under the Secure 2.0 Act, which took effect in 2024. The account continues to grow tax-deferred, and the former employer is required to maintain it. That may sound straightforward, but the ongoing costs matter. According to financial advisor Matt Sorensen, writing in March 2025, the average small business 401k charges 1.5% in annual fees. Investment options are limited to whatever the plan offers, typically a short list of mutual funds and target date funds. Contributions cannot resume, and depending on the plan's specific terms, the account holder's ability to access even their own money may be restricted. Some plans do offer genuine advantages worth preserving. Certain large employer plans provide access to institutional-priced index funds that are not available to individual investors through a standard IRA. There is also a creditor protection consideration. Funds held inside a 401k generally carry stronger legal protections than assets in an IRA. Financial advisors at Fidelity and Vanguard typically recommend consolidation for simplicity and lower fees, but the decision depends on the specific plan's terms and the account holder's circumstances. Rolling the balance into a new employer's plan is a second option. It consolidates accounts and keeps retirement savings in a single location. The new plan must accept incoming rollovers, however, and not all do. Investment choices remain restricted to whatever the new plan offers, and withdrawal rules are often more limiting than those governing IRAs. Rolling into a new employer's plan does not generate additional employer matching. The match is determined by the employee's ongoing contributions, not by the transferred balance. Rolling into an IRA, either a traditional IRA or a Roth IRA, is the path most financial institutions recommend for most workers in most situations. IRAs offer a broader range of investment options, typically lower administrative fees, and greater flexibility in managing withdrawals. The critical factor is how the transfer is executed. A direct rollover moves funds from the old plan to the new IRA without passing through the account holder. No withholding is triggered, and there is no deadline to meet. An indirect rollover works differently. The distribution is paid directly to the account holder, and federal law requires the plan to withhold 20% for taxes at the point of distribution. The account holder then has 60 days to redeposit the full original amount, including the 20% that was withheld, into the IRA. If the full amount is not redeposited within 60 days, the IRS treats the shortfall as a taxable distribution. For workers under 59 and a half, A 10% early withdrawal penalty applies on top of ordinary income taxes. The 20% that was withheld does not disappear. It is credited against the tax liability when the worker files, but it must be replaced out of pocket during the 60-day window, which many people cannot do. The practical guidance is straightforward. Request a direct rollover. Confirm in writing that funds will move institution to institution. Do not accept a check made out to you personally if the intent is to roll the money over. A full cash distribution is the most costly option for most workers. The plan withholds 20% for federal taxes at the time of distribution. For workers under 59.5, the additional 10% early withdrawal penalty applies when taxes are filed. Combined with New York State income taxes, which apply to retirement distributions, the effective loss for many workers in this city can reach 40% or more of the account balance. A worker cashing out $30,000 could realistically take home less than $18,000 after all applicable taxes and penalties. The remainder, money that took years to accumulate and that would have continued compounding, is gone permanently. There is one age-based exception to the early withdrawal penalty. Under what is commonly called the Rule of 55, workers who separate from their employer in or after the year they turn 55, or 50 for certain public safety workers, may take penalty-free withdrawals from the 401k of the specific employer they just left. Ordinary income tax still applies. The rule does not extend to prior employer plans or to IRAs, only to the plan associated with the job most recently held. Vesting is a distinct issue that frequently determines how much of an account balance actually belongs to the worker at the time they leave. Employee contributions, money withheld from the worker's own paycheck, are fully owned by the employee from the moment they are deposited. The IRS mandates this. Employer matching contributions operate under a different set of rules. Those funds are subject to a vesting schedule, meaning ownership transfers to the employee either gradually or after meeting a specific tenure threshold. Until that threshold is reached, the employer retains the right to reclaim unmatched contributions if the worker leaves. According to UpCounsel's August 2025 analysis, roughly 22% of employers offer immediate vesting of matched contributions, meaning the match is fully owned by the employee from day one. A similar share of employers use cliff vesting, under which the employee receives none of the employer match if they leave before a defined cutoff date. If that date is 3 years and the employee leaves at 2 years and 11 months, the entire employer match reverts to the company. The remaining approximately 50% of employers use graded vesting, which releases a percentage of the match each year until the employee reaches full ownership, typically over a 5-year period. The dollar amounts involved are not trivial. Fidelity, the largest 401k plan provider in the country with approximately 25,000 plans as of March 2025, reports that more than 85% of the plans it administers offer some form of employer contribution. The most common formula is a dollar-for-dollar match on the first 3% of salary, followed by 50 cents on the dollar for the next 2%. For a worker earning $80,000 per year under that formula, the full employer match is $3,200 annually. Under a 5-year graded vesting schedule, leaving after 3 years might mean forfeiting 40% of that accumulated match, roughly $3,800 in contributions that were recorded as belonging to the employee, but legally were not yet theirs. According to the Bureau of Labor Statistics, 41% of companies that offer a 401k match up to 6% of salary. The average employer match in 2026 is estimated at between 4 and 6% of pay, according to Carey's March 2026 analysis. Nearly half of all employers, however, offer no match at all. There is also a federal protection that applies specifically in mass layoff situations, and it is rarely communicated to workers. When a company reduces its workforce by roughly 20% or more within a single plan year, the IRS may determine that a partial plan termination has occurred. Under that determination, all employees affected by the reduction must be immediately and fully vested in 100% of their employer contributions, regardless of where they stood in the vesting schedule. The employer is required to restore any previously forfeited match amounts. WIS-CP, as noted in September 2025, that this rule is frequently unknown to both workers and the HR departments responsible for administering the plans. Any worker separated during a period of significant workforce reduction should verify with the plan administrator whether a partial plan termination was triggered and whether additional vesting was owed. For accounts with small balances, The Secure 2.0 Act sets specific rules that determine what happens if the account holder takes no action. Balances under $1,000 may be distributed by the employer as a check, with taxes withheld automatically. Balances between $1,000 and $7,000, if no election is made, must be rolled by the employer into an IRA. That IRA may be opened at a financial institution the former employee has no existing relationship with, and the notification may be easy to miss amid the administrative noise of leaving a job. An untracked automatic rollover becomes another entry in the growing count of accounts that workers do not know they have. The scale of the forgotten account problem has grown consistently for years. Capitaliz's 2025 research found the number of left-behind accounts is nearly double what it was a decade ago. The firm attributes the growth to three overlapping factors: rising 401k participation rates, continued job changing across the workforce, and persistent complexity in the rollover process that creates friction at the exact moment a decision needs to be made. Their analysis found that a worker managing multiple forgotten accounts, paying above-average plan fees, and holding assets in poorly allocated funds could lose several $100,000 in retirement savings over a lifetime compared to a worker who consolidated into a low-cost, actively managed account. Charles Schwab has noted that accounts left unattended for long enough can be converted to cash and transferred to the state as unclaimed property, at which point recovering them requires navigating state government processes. In December 2024, the Department of Labor launched a tool designed to address part of this problem. The Retirement Savings Lost and Found database, established under the Secure 2.0 Act, went live on December 27, 2024. The database allows individuals to search for retirement plans, including 401k accounts and defined benefit pensions, linked to their Social Security number. From its launch through the end of 2025, the database recorded 236,000 unique visitors. Of those, approximately 29.5%, roughly 69,000 people, located at least one old account. Tyler Compton, Director and Managing Attorney for the Pension Action Center at the University of Massachusetts, Boston, told CNBC that recovered amounts have ranged from approximately $350 per month in pension annuities to 401k account balances of roughly $20,000. The database carries a significant limitation. It currently covers only individuals 65 and older. The Department of Labor indicated in a 2024 Federal Register notice that it began with that age group because those individuals are more likely to need access to the database sooner. Compton stated publicly, "I'm hoping an expansion will include any age." For working-age New Yorkers who have left multiple jobs over the course of a career, the database is not yet a complete solution. Additional search options exist. MissingMoney.com aggregates unclaimed property databases across all 50 states and allows multi-state searches. The National Registry of Unclaimed Retirement Benefits, operated by Penchecks Trust, maintains a separate database using employer and Department of Labor data. For former employers still in operation, the plan administrator can be contacted directly. For companies that have been acquired or dissolved, the Department of Labor's Form 5500 database, which covers annual retirement plan filings since January 2010, can identify the administrator currently responsible for the plan. In New York, a new layer of retirement policy is actively taking effect in 2026. On October 8, 2025, Governor Kathy Hochul announced the formal launch of the New York State Secure Choice Savings Program. The program was enacted into law in 2018 and has now moved into mandatory compliance. Private sector employers with 10 or more employees and at least 2 years of operating history are required to either offer a qualified retirement plan, such as a 401k, 403b, SEP IRA, or simple IRA, or enroll workers in the state-administered Secure Choice program. Compliance deadlines are tiered by employer size. Employers with 30 or more employees were required to register by March 18, 2026. Those with 15 to 29 employees face a May 15th deadline. Employers with 10 to 14 employees have until July 15th. Penalties for noncompliance begin at $250 per employee for a first offense and increase with subsequent violations, according to the New York State Compliance Framework. The Secure Choice program is structured as a Roth IRA. It is not a 401k. Employees are automatically enrolled at a default contribution rate of 3% of gross wages. They may opt out at any time, adjust their contribution rate, or modify their investment selections. Employers are neither required nor permitted to make matching contributions under the program. Participants may not borrow against the account balance. The accounts are portable. They remain with the employee regardless of employer, making them structurally different from a 401k that stays attached to the plan sponsor. For workers at small businesses across the city that have not previously offered any retirement savings vehicle, Secure Choice represents first-time access to a workplace savings mechanism. Research cited in the program's rollout documentation found that employees are 15 times more likely to save when they can do so through their employer, and 20 times more likely when automatically enrolled. The portability of the Secure Choice Roth IRA is a meaningful distinction for workers in industries with high turnover. The account moves with the worker, rather than creating another potential orphaned balance at a former employer. Several provisions of the Secure 2.0 Act affect current workers in ways that have received limited attention. Beginning in 2024, 401k plans may permit one penalty-free emergency withdrawal per calendar year of up to $1,000. Ordinary income tax still applies on traditional account withdrawals, but the 10% early withdrawal penalty is waived for this specific provision. This applies to qualified unforeseen financial needs and is available once per calendar year. For workers starting a new job, the timing of enrollment matters more than many realize. Bankrate, citing retirement advisor Bogosian in September 2025, noted that even when a new employer has an automatic enrollment feature, that enrollment may not activate for 1 to 3 months after hire. A worker who relies on automatic enrollment rather than actively registering may miss 30 to 90 days of contributions and, more consequentially, 30 to 90 days of employer matching that cannot be recovered retroactively. Enrolling on the first day of employment eliminates that gap. For workers between the ages of 60 and 63, the Secure 2.0 Act established a higher catch-up contribution ceiling beginning in 2025. The standard catch-up limit for workers over 50 is $7,500 annually above the regular contribution limit. For workers specifically in the 60 to 63 age range, that limit increases to $11,250, defined as 150% of the regular catch-up amount. For 2025, the total allowable 401k contribution for workers in that age group reaches $34,750. The regular contribution limit for workers under 50 is $23,500, with a combined employer and employee cap of $70,000 for that group. The decisions made about a 401k at the point of leaving a job carry consequences that accumulate over years. 31.9 million accounts representing $2.1 trillion reflect what happens, in aggregate, when those decisions are not made. Workers who verify their vesting status before leaving understand which rollover method applies to their situation and complete account transfers promptly at each job. Transition preserve the value of contributions made over years of employment.